Today we're going to talk about how taxes and insurance and homeowners associations actually affect how much you're pre-approved for. So stick around. All right, so class is in session, and today we're going to learn about what goes into qualifying somebody and determining how much sales price can they actually afford. So two things to keep in mind. Number one, lenders don't qualify people based on sales prices. We qualify them based on debt to income ratios, and those ratios are different for every type of loan. Number two, when we're looking at sales prices and we're looking at what type of option we need to look at, the debt to income ratios that we look at are the front end ratio and the back end ratio. Now listen, this video, we're not going to dive too deep into how we actually calculate those ratios, but for this instance, here's what you need to know. If you look at the top of my screen, you'll see that there are two DTI ratios. There's a front end ratio and a back end ratio. All you need to know is that the front end ratio is calculated by taking your total monthly mortgage payment on the new house that you're buying, including taxes and insurance and HOA fees, and dividing it by your gross monthly income. The back end ratio, which here you see it's 44.683, is your total monthly mortgage payment plus any debt that you're paying, like credit cards, student loans, car loans, personal loans, all of those monthly payments divided by your gross monthly income. So what we end up with are two ratios. Now in this instance, what I want you to keep in mind is that we are working with a conventional loan with 3% down, which typically, and I say typically because there are some loan programs that allow us to go a little bit higher than 45%, but typically we are capped at a 45% debt to income ratio. Now, what is this video about? The reason I want to talk about this is because as people here in Charleston start looking at, I'm starting to get a lot more buyers that are looking at townhouses and condos as options to buy in the specific parts of town that they want to be in versus single family homes. So when I get the question of, well, hey Chris, how much can I buy? Or the realtor says, what's the maximum amount that they can go up to? It's really hard to give a number. So I figured, why don't I just show you how it works, and that way you can have a better understanding of what goes into qualifying for a mortgage. So listen, in this scenario, I have a purchase price of $315,000. The client's putting 3% down, which is $9,400, and with taxes and insurance and PMI, because they're putting less than 20% down, the total monthly mortgage payment is $1,634. Now, in this scenario, we have their debt to income right at 45%. This is about the limit that this specific client can qualify for. But what happens when I get a contract or I get a property request and they say, hey, it's a townhouse and it's $315,000, but there's a $250 monthly HOA fee. So if I add that in here, $250, now you can see my debt to income has gone from 44.6 and change all the way up to 49.6, which means that this client doesn't qualify for that home, which means that I can't just across the board say, this person qualifies for a $315,000 home. Well, then the question becomes, well, what can they qualify for? And that's where it gets very tricky, especially in our area where we have regime fees, HOA fees, flood insurance, wind and hail zones, all these different types of things that go into your mortgage payment that we have to take into account, and your approval is all based on monthly debt to income, not sales prices. I can't say that enough. It has nothing to do with what the sales price is. Now listen, this is something that I've learned a while ago in a number or ratio that I use. For every $100 in monthly HOA fee, you're going to affect the sales price that someone can qualify for by about $20,000. So in this case, if we took the $250 HOA fee, so that's $20,000, $40,000, and then we have $50, that's $10,000. So it's about a $50,000 swing in sales price that we need to be looking at. So let's plug that in. I'm going to reduce the sales price of $315,000 down to $265,000, and I'm going to keep the down payment right at 3%. Now listen, is this perfect? No, it's not perfect, but you'll see it's really close. Look at our debt to income. I'm at 45.1. Maybe I get a little bit of a cheaper insurance policy, that 1/10 of a percentage point, we can figure that out. Maybe we drop the rate a little bit, maybe confirm what taxes are, shop the homeowner's insurance around, but we can figure out. So in this scenario, with a $250 HOA fee, this person went from being able to afford a single family home that's $315,000 to this townhouse of $265,000. Now, we haven't even gotten into, well, what if there's flood insurance, or what if the fee is $150 a month? Well, let's just say that it's $150 a month. Now I have some room to work on my debt to income. So let's say we went up to $285,000. So I'm at 44.9. So now I hope that you're understanding and kind of getting it to click where, oh wait, so the HOA fee affects how much house I can get qualified for, and it's not so much the sales price, it's how does that HOA or regime fee each month affect it? So here's, what I want you to keep in mind. When we're looking at properties and we're trying to help a client figure out how much house they can get qualified for, we look at it as monthly debt to income. We don't look at the sales price, okay? Someone can go out and buy $1 million home and put $900,000 down, and the income necessary to carry that $100,000 loan is a lot less than somebody buying a $100,000 home that also has a $5,000 flood insurance fee, a $500 a month HOA fee. So they flip-flop. So one thing to keep in mind, and something that I try to tell my clients is, here's the max mortgage payment that you can qualify for. How we get there is going to be based on the property that you're looking at. So again, what does this all go back to? It goes back to me getting the phone call or the text that says, what's the max that they can qualify for? And the answer is, it depends. And it depends on what is the property going to cost when we break it down to a monthly number. So I hope that this video helps kind of understand how we look at these numbers. Again, they're all based on monthly income, outgoing debt, what is the property going to be made up of. But hopefully you'll remember a couple things. When you're looking at HOA fees, they typically, every $100 in monthly HOA fee is going to affect that sales price by $20,000. And when you're keeping in mind, when you're working with a client, or when you are yourself, you're looking at a property, make sure that you know what is your max total monthly mortgage payment that you can get qualified for, so you don't put yourself in the position that I've seen over the last 11 years where somebody brings me a contract, I didn't have an opportunity to run the numbers before. All they knew was I had a pre-approval for $300,000. Well, they bought a $275,000 house with a $300 a month HOA fee, which puts them over their limit. And that's where I see the biggest hiccups in lending, is where they feel or they think that, oh, it's less than, the sales price is less than what I was pre-approved for. No problem, no questions asked. That's not the case. We have to take it all into account, look at it as a monthly payment, and that way you'll know exactly how much you can get qualified for. Hey, listen, I hope you enjoyed this video. I thought it might be a little bit better to share my loan software with you so that you can see how these fees, such as insurance and taxes and homeowners associations, actually affect how much you're pre-approved for. So if I brought value to you, then please like, comment, subscribe as I bring content to you each and every week. Thanks so much for watching. See you next time.